You've been told that buying an S&P 500 index fund is the safest way to invest. Diversified across 500 companies. Set it and forget it. But here's what they didn't tell you: 32% of that diversified fund sits in just 7 stocks. 7 companies out of 500 control nearly a third of everything. This isn't about market timing or fear-mongering. This is about understanding a concentration of risk that has never existed before in a century of recorded market history, and that concentration is about to unwind. December 31st, 2025. The S&P 500 closes at an all-time high. Financial news anchors toast champagne on air. Retirement accounts show record balances. Everything looks perfect. And that's exactly when you should be paying attention. Here's a number that should stop you cold. 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla represent $14.2 trillion in market capitalization. That's 32% of the entire S&P 500 concentrated in 7 names out of 500. If you could see a pie chart of the index right now, nearly 1/3 of it would be filled by just 7 slices, while the remaining 493 companies share the rest. The bottom 250 companies in the S&P 500, half the entire index, have a combined market cap of $3.1 trillion. The Magnificent Seven are worth 4.6 times more than the bottom half of the index combined. 7 companies are worth more than 250 companies. That's not a market. That's a monopoly disguised as diversification. Sandra Mitchell still remembers the exact moment she felt wealthy. It was Thanksgiving 2025, and she was sitting at her dining room table in suburban Phoenix, scrolling through her Fidelity app while the turkey rested. Her 401k had just crossed $840,000. At 52 years old, after 28 years of teaching high school history, she finally felt like retirement was real. She showed her husband the screen. He smiled and said, "See, staying in the market always works." She didn't know that 32% of her life savings, nearly $270,000, sat in 7 stocks trading at valuations that have never been sustained in market history. She didn't know because no one told her. What most people get wrong about index funds is this: they believe diversification means safety. 500 companies sounds safe. It sounds spread out. It sounds like no single failure could hurt you. But the S&P 500 isn't equally weighted. It's market cap weighted. The bigger a company gets, the more of your money goes into it. And right now, 7 companies have gotten so big that they dominate everything else. If those 7 stocks fall 40%, your diversified portfolio doesn't fall 13%. It falls much harder because those 7 stocks drag down sentiment, trigger forced selling, and create cascading losses across everything they touch. Here's a question worth sitting with. If concentration like this is so dangerous, why did everyone let it happen? The answer is uncomfortable. No one let it happen. It happened automatically. Every passive index fund, every 401k automatically allocated to the S&P 500, every target date retirement fund, they all buy based on market cap. The bigger a stock gets, the more money flows into it. The more money flows in, the bigger it gets. It's a self-reinforcing loop that no one controls and no one can stop. Richard Yamamoto saw this loop from the inside. At 47, he manages a $2.3 billion pension fund for municipal workers in California. Every quarter he watches as new contributions flow into the fund and get allocated according to index weights. Every quarter, 32% of that money automatically goes to the Magnificent Seven, not because Richard analyzed these businesses and concluded they're worth their valuations, but because that's what the index demands. He once raised concerns in a board meeting. "We're concentrated in 7 stocks at historical valuation peaks," he said. The response was silence then. That's what the benchmark requires. Richard went home that night and moved his personal retirement savings into treasury bonds. The numbers are stark. These 7 stocks trade at an average price-to-earnings ratio of 42. The historical average for market leaders is 22. To justify current valuations, these companies need to grow earnings 25% annually for the next 5 years. But here's the problem. They're not growing at 25%. They're growing at 12%. And that growth is decelerating. Apple's iPhone sales peaked in 2021. Microsoft's cloud growth is slowing. Nvidia faces China export restrictions. Tesla trades at a PE of 72 for a car company growing 8% annually. The math doesn't work. And when math doesn't work, it eventually stops working violently. Jennifer Okafor learned about math the hard way. She was 34 years old in March 2000, a software engineer in San Jose who had invested $180,000 in technology stocks, mostly names everyone knew and loved: Cisco, Intel, Microsoft, Sun Microsystems. Her portfolio hit $340,000 at the peak. She felt invincible. By October 2002, she had $94,000 left. She didn't sell at the bottom, she held on just like everyone advised. But some of those stocks never recovered. Sun Microsystems went to zero. Cisco never returned to its 2000 price. 25 years later, Jennifer is still working. Not because she wants to, but because she has to. She stayed in the market. The market didn't stay with her. Now look at the contrast. David Brennan was also 34 in March 2000, working as an accountant in Chicago. He didn't have insider knowledge or a finance degree, but he noticed something that bothered him. His barber was giving stock tips. Everyone at his gym was talking about their portfolios. It felt too easy. In January 2000, he moved 70% of his portfolio to bonds and cash. His colleagues mocked him for missing the rally. By October 2002, while they had lost half their savings, David had lost almost nothing. He bought back into stocks at the bottom and retired at 57. Same era, same companies, same crash, opposite outcomes. There's a mechanism behind how 7 companies captured 32% of the market. There's a mechanism behind how that concentration will reverse. And there's a timeline clearer than most people realize for when that reversal begins. Understanding the mechanism won't tell you exactly when the crash hits, but it will tell you something more important: why the crash is mathematically inevitable. And that mechanism has already started to break. We ended part 1 with a statement. There's a mechanism behind how 7 companies captured 32% of the market, and that mechanism has already started to break. Now let's understand exactly how that mechanism works, because once you see it, you can't unsee it. The story begins with a simple idea that revolutionized investing: passive index funds. In 1976, John Bogle launched the first index fund available to regular investors. The premise was elegant. Instead of paying expensive fund managers to pick stocks, most of whom underperformed the market anyway, why not just buy the entire market? Lower fees, less complexity, better results over time. It worked. For decades, it worked beautifully. And that success created something no one anticipated: a machine that automatically concentrates money into whatever is already big. Here's how the mechanism operates. When you invest in an S&P 500 index fund, your money doesn't get divided equally among 500 companies. It gets allocated based on market capitalization, the total value of each company's shares. If Apple represents 7.9% of the index's total value, then 7.9% of every dollar you invest goes to Apple. Not because anyone analyzed Apple and decided it deserves 7.9% of your money. Simply because Apple is big. Think of it like a voting system where the candidates who are already winning get more votes. The more votes they have, the more new votes they receive. The system doesn't measure quality. It measures size. And size feeds on itself. Marcus Chen spent 22 years building trading algorithms for a quantitative hedge fund in Connecticut. At 51, he understands the mathematics of market structure better than most people alive. He still remembers the exact moment he realized passive investing had changed everything. It was 2019, and he was analyzing fund flows, the movement of money into and out of different investment vehicles. "I pulled up the data," he told me, "and I just sat there staring at my screen. $11 trillion in passive funds, all buying based on the same market cap weights. Every single day, money flows in and mechanically bids up the same stocks. It's not investing anymore. It's momentum dressed up as diversification." There's currently $11 trillion invested in passive index funds and ETFs tracking the S&P 500. Every day, new money flows in from 401k contributions, pension deposits, automatic investment plans. And every day, 32% of that money goes to 7 stocks, not because portfolio managers chose them, but because the formula demands it. What most people get wrong about passive investing is this: they think it's neutral. They think buying the market means they're not making active bets. But passive investing at this scale isn't neutral at all. It's a massive active bet that whatever is currently biggest deserves to keep getting bigger. The index doesn't ask whether Apple at $3.5 trillion is overvalued. It doesn't ask whether Nvidia at a PE of 58 makes sense. It just keeps buying. Now, here's where it gets dangerous. The same mechanism that pushes prices up will push them down, but faster and more violently. Imagine a crowded theater with one exit. When everyone's calm, people flow in and out smoothly. But when someone yells fire, everyone rushes for the same door at the same time. In the S&P 500, that door is 32% controlled by 7 stocks. When redemptions hit, when people start pulling money out of index funds, the funds must sell holdings to raise cash. And because of market cap weighting, 32% of those sales hit the Magnificent Seven. If $100 billion flows out, $32 billion in selling pressure hits 7 stocks. The same concentration that amplified the gains will amplify the losses. Remember Richard Yamamoto from Part 1. The pension fund manager who moved his personal savings to treasury bonds while his fund kept buying the Magnificent Seven. He understood something his board didn't. On the way up, he explained, "The mechanism is invisible. Everyone's happy. Returns are good. No one questions why we keep putting money into the same 7 names. But on the way down, the mechanism becomes a trap. We can't sell faster than everyone else. We're all trying to exit through the same door at the same time, and we're required to hold what the index holds." Let me show you the concentration in historical context. If you could see a chart spanning from 1926 to today, showing the percentage of total market value held by the top 7 stocks, you'd see something remarkable. The line fluctuates between 10% and 20% for most of history. During the Nifty 50 bubble of 1972, it spiked to 19%. During the dot-com peak of 2000, it reached 22%. And then there's today, 32%. The current concentration isn't just high, it's off the chart. Literally beyond anything recorded in a century of market data. Here's a question worth asking: if concentration has reached unprecedented levels, what makes anyone think it can keep going? The answer is that nothing makes them think it. They simply don't think about it at all. The mechanism operates automatically. No one decides to concentrate the market. No one approves it. It just happens one fund flow at a time, until suddenly 32% of America's retirement savings depends on 7 companies continuing to grow at impossible rates. Patricia Okonkwo manages compliance for a mid-sized asset management firm in Boston. At 44, she's watched the industry transform over 2 decades. She still remembers the exact moment the implications hit her. "I was reviewing our 2035 target date fund," she said. "The kind of fund we put people's retirement savings in when they're planning to retire in 2035. I looked at the holdings and realized 75% of this fund is in the S&P 500, and 32% of the S&P 500 is 7 stocks, which means roughly 24% of someone's entire retirement, their whole financial future, is riding on Apple, Microsoft. Nvidia, Amazon Alphabet Meta, and Tesla, maintaining valuations that have never been sustained in history. She paused. We're not diversifying risk. We're concentrating it and calling it diversification. But here's the twist that rarely gets discussed. This concentration didn't happen because the Magnificent Seven are the best companies. It happened because they got big, and bigness attracts more money, and more money makes them bigger. The mechanism is circular. It rewards size, not quality. And it has pushed these 7 stocks to valuations that require something close to perfection to justify. Apple trades at a PE of 33 with declining iPhone sales. Microsoft trades at 36 times earnings with cloud growth decelerating. Nvidia trades at 58 times earnings while facing export restrictions to China, its second largest market. Tesla trades at 72 times earnings for an 8% growth rate, a valuation that would be absurd for any car company in history. The prices assume growth that isn't happening. The mechanism keeps pushing money in anyway. And somewhere a breaking point approaches. Angela Reyes has been a financial advisor in Houston for 19 years. She still remembers the exact moment a client made her question everything. He was a 61-year-old engineer 4 years from retirement with $1.2 million in his 401k. He came in and said he wanted to be conservative, Angela recalled. So I put him in a standard target date fund. Supposed to be the safe choice. Later, I calculated 24% of his conservative retirement fund was in 7 stocks at record valuations. That's not conservative. That's a concentrated bet with his entire future. The mechanism that built this concentration is now pushing against mathematical limits. Growth is slowing, valuations are stretched, and the passive money keeps flowing in, indifferent to fundamentals. Something has to give. And when it does, the same mechanism that created the concentration will destroy it. The question is no longer whether the reversal happens. The question is what triggers it and how fast the cascade unfolds. We ended part 2 with a question: what triggers the reversal and how fast does the cascade unfold? The mechanism that built the concentration is pushing against mathematical limits. Growth is slowing. Valuations are stretched. Something has to give. Now, let's watch it give. The public story is simple. The Magnificent Seven are the greatest companies in the world. They dominate artificial intelligence. They control the platforms everyone uses. They generate massive profits. Buying them is buying the future. The reality is different. Let me show you company by company what's actually happening beneath the headlines. Apple, the most valuable company on earth at $3.5 trillion, trading at 33 times earnings. The narrative says Apple is a services company, now recurring revenue, high margins, endless growth. The reality: iPhone sales, which still represent 52% of Apple's revenue, peaked in 2021 at 240 million units. In 2025, Apple sold 232 million iPhones. That's not flat. That's declining. The global smartphone market is saturated. Everyone who wants a smartphone has one. Replacement cycles have stretched from 2 years to 4 years as phones become more durable and innovations become incremental. Services growth. The supposed savior has decelerated from 18% in 2023 to 9% in 2025. Apple isn't growing into its valuation. It's shrinking away from it. Microsoft, trading at 36 times earnings. The narrative says Azure cloud computing will grow forever, and AI will add hundreds of billions in new revenue. The reality: Azure grew 26% last year, down from 46% at its peak. Still impressive, but decelerating. And here's the uncomfortable question. No one asks if AI is this massive revolution that justifies trillion-dollar valuations. Why isn't total company revenue growth accelerating? Microsoft's overall revenue grew 12% last year. If AI is transforming everything, shouldn't that number be going up, not staying flat? Nvidia, trading at 58 times earnings. The poster child of the AI boom. The narrative says every company needs NVIDIA chips. Demand is infinite, growth is unlimited. The reality, China represents a significant portion of NVIDIA's market and export restrictions are tightening. More importantly, the biggest cloud providers, Amazon, Microsoft, Google, are developing their own custom AI chips specifically to reduce dependence on NVIDIA. The customers that made NVIDIA a $3 trillion company are actively working to need NVIDIA less. That's not a growth story. That's a peak story. Teresa Huang still remembers the exact moment she understood how vulnerable her position was. At 39, she'd spent 8 years as a product manager at one of the Magnificent Seven, a company she believed in completely. Her compensation was 60% stock. Her retirement account was 80% in company shares, and S&P 500 funds that were themselves 32%. Magnificent Seven. She did the math one Sunday afternoon. 74% of her entire net worth depended on 7 stocks maintaining valuations that had never been sustained in history. I felt sick, she told me. I'd built my whole financial future on the assumption that these companies would keep growing at rates they were already failing to achieve. She sold half her position the next week. Her colleagues thought she was crazy. She thought she was finally sane. Here's the timeline of how this unwinds. Q1 2026. January through March. Earnings season reveals what the optimists have been ignoring. Apple reports iPhone sales down 4% year-over-year. Services growth slows to 8%. Management provides cautious forward guidance. Microsoft reports Azure growth of 15%, well below expectations. The AI revenue everyone was counting on hasn't materialized at scale. NVIDIA's numbers are still strong, but management mentions moderation in data center spending. If you could see a chart of analyst sentiment during this quarter, you'd watch it shift from confident green to cautious yellow. Not panic, not yet, but the first cracks in the narrative. Small hedge funds, the ones not constrained by investment banking relationships, begin establishing short positions. Boutique research firms, the ones with no business ties to these companies, start publishing bearish analyses. Goldman Sachs, Morgan Stanley, and JP Morgan remain stubbornly bullish. They have to. These 7 companies are also their investment banking clients. Billions in advisory fees depend on maintaining good relationships. The analysts can't afford to tell the truth. Pause and consider what that means. The major institutions that millions of Americans trust for financial guidance cannot provide honest analysis because their business model depends on keeping these companies happy. By the end of Q1, the Magnificent Seven are down 14% to 22% from their December peaks. NVIDIA leads the decline at 22% because it was the most overvalued. The S&P 500 is down 8%. The narrative shifts from healthy correction to, is this something more serious? Q2 2026. April through June. This is when correction becomes crash. April earnings confirm the problems are worsening, not stabilizing. Apple reports iPhone sales down 5% year-over-year. China revenue collapsed 12% as Chinese consumers boycott American brands in favor of Huawei. Stock falls another 12% in 2 days. Microsoft reports Azure growth of 11%. Investors finally ask the question. Teresa asked if AI is revolutionary. Why is growth decelerating? Stock falls 11%. NVIDIA reports that 3 major cloud providers have reduced GPU purchases in favor of custom chips. Revenue still grew 22%, but that's down from 38% the previous quarter. The deceleration is accelerating. Stock crashes 18% in a single day. If you could see NVIDIA's stock chart on that afternoon, you'd watch a vertical red line drop through support level after support level. And then the capitulation happens. Goldman Sachs downgrades Apple, Microsoft, and NVIDIA to neutral with substantially reduced price targets. Morgan Stanley follows within hours. JP Morgan follows the next day. The narrative flips overnight from buy the dip to wait for clarity. But clarity never comes during crashes. Investors don't wait. They panic. Remember Sandra Mitchell from Part 1. The 52-year-old teacher in Phoenix who felt wealthy when her 401k crossed $840,000. By the end of June, that account shows $588,000. She hasn't made a single trade. The money simply disappeared while she was teaching American history to 11th graders. $252,000 gone. She keeps checking her phone between classes, watching the number drop, unable to stop it, and unable to look away. Here's what most people get wrong about market crashes. They think crashes are caused by panic. They're not. Panic is the accelerant, not the cause. The cause is mechanical. Redemptions from S&P 500 index funds spike $180 billion flows out in April and May combined. Index funds must sell holdings to meet those redemptions. Because of market cap weighting, 32% of those sales, $58 billion, hit 7 stocks. That's $58 billion in forced selling crashing into the same 7 names, not because anyone decided these companies are worth less, but because the mechanism demands it. Raymond Castellanos managed money for ultra-high net worth clients at a boutique firm in Manhattan. At 53, he'd seen every market cycle since 1987. He still remembers the exact moment he knew this crash was different. "I was watching level 2 quotes on Nvidia," he said. "The order book. I've never seen anything like it. Every bid would get hit, and there was just nothing underneath. Air pockets. The passive sellers were dumping into a vacuum. There was nobody there to catch it." In 1 hour, he watched $47 billion in market cap disappear from a single stock. The cascade accelerates. Prices fall. Falling prices trigger stop losses. Stop losses trigger more selling. Algorithmic trading systems detect the breakdown and flip from long to short. Momentum strategies reverse. Risk parity funds mechanically reduce equity exposure as volatility spikes above 35. By the end of June, the Magnificent Seven are in free fall. Apple down 38% from peak. Microsoft down 36%. Nvidia down 53%. Amazon down 41%. Alphabet down 34%. Meta down 39%. Tesla down 58%. The S&P 500 is down 26%. The Nasdaq is down 35%. This is officially a crash. And here's the rage-inducing part. While Sandra Mitchell watches her retirement evaporate, while Teresa Huang's former colleagues lose half their net worth, while pension funds across America become underfunded, the executives at these 7 companies have been selling. SEC filings show insider sales accelerating throughout late 2025 and early 2026. They knew. They sold their shares to the index funds that were mechanically required to buy. The insiders got out. The index investors got trapped. The system worked exactly as designed. Just not for the people who believed in it. Q3 2026 completes the cascade. But the real damage extends far beyond stock prices. What comes next isn't just a market recovery story, it's a reckoning. We ended Part 3 with the cascade completing in Q3 2026 and a statement: the real damage extends far beyond stock prices. What comes next isn't just a market recovery story, it's a reckoning. Now let's trace that reckoning forward, not months, but years. Because the cruelest part of a crash isn't the fall. It's the slow grinding aftermath that follows. By September 2026, the Magnificent Seven have reached their lows. Apple down 48% from peak. Microsoft down 46%. Nvidia down 62%. Amazon down 51%. Alphabet down 43%. Meta down 47%. Tesla down 71%. Combined market cap destruction, $7.1 trillion. The S&P 500 bottoms at 3,700 down 46% from its December 2025 peak. If you could see a single image capturing this moment, it would be a retirement statement. 2 pages. One number circled in red. And someone staring at it in disbelief. What most people get wrong about market crashes is this. They think the bottom is the worst part. It isn't. The bottom is painful but brief. The real destruction happens in the years that follow the slow erosion of financial plans, the quiet postponement of retirements, the gradual acceptance that life will be smaller than expected. Remember Sandra Mitchell from Part 1. The Phoenix teacher whose 401k crossed $840,000 at Thanksgiving 2025. Let me show you her trajectory. By September 2026, her account shows $453,000. She's lost 46%, nearly $400,000 in 9 months. She's 53 years old now. She planned to retire at 60. The math no longer works. To reach her original retirement goal, she would need 9.5% annual returns for the next 7 years. Historically, the market averages 7%. She's not going to make it. By 2034, when she turns 61, her portfolio has recovered to $680,000. Better than the bottom, but still $160,000 below where she was in late 2025. She postpones retirement to 65. Then 67. She finally stops working at 68 with just enough to live modestly if nothing goes wrong. 9 years of her life years she planned to spend with grandchildren traveling, finally resting traded for a market cycle she didn't understand and couldn't control. Now contrast that with someone who saw it coming. Nathan Brooks was 51 in late 2025, a pharmacist in suburban Atlanta with $720,000 in retirement savings. He wasn't a financial genius. He didn't have insider information. But he read an article about market concentration that made him uncomfortable. 32% in 7 stocks at record valuations. He moved 50% of his portfolio to short-term treasury bonds in November 2025. His financial advisor told him he was making a mistake timing the market, letting fear win. By September 2026, while accounts like Sandra's had fallen 46%, Nathan's portfolio was down just 23%. He still had $554,000. And then he did something that changed his trajectory permanently. He rebalanced back into stocks at the bottom. He bought what everyone else was panic selling. By 2034, Nathan's portfolio has grown to $1.4 million. He retires at 63 years early with more money than he ever expected. Same starting point as Sandra. Same crash. Same economy. A difference of $720,000 in outcomes based entirely on understanding concentration risk before it was too late. The divergence compounds over time. If you could see 2 lines on a chart, Sandra's trajectory versus Nathan's, you'd watch them start at similar points, then split apart dramatically. By 2036, the gap exceeds $800,000. 2 people, same age, same income bracket, same crash, opposite financial futures. Here's a question worth sitting with. Why doesn't anyone warn people about this in advance? The answer is uncomfortable, but simple. The financial industry makes money when you stay invested. Every dollar in your 401k generates fees for fund managers, for administrators, for advisors. If they warned you about concentration risk, you might reduce exposure. You might move to cash. You might ask difficult questions. It's easier to say, stay the course, and collect fees while the mechanism does its work. The pension funds face an even grimmer reality. Remember Richard Yamamoto from Part 2, the California pension manager who moved his personal savings to treasury bonds while his fund kept buying the Magnificent Seven. Let me show you what happened to his fund. The California Municipal Workers' Pension held $48 billion in assets in late 2025, with index-weighted exposure of 32% to the Magnificent Seven. When the crash hit, that concentration translated to $12.4 billion in losses on 7 stocks alone. Total fund losses exceeded $18 billion by September 2026. The fund's actuarial calculations, the math that determines how much money will be available for future retirees, went from 87% funded to 64% funded. That gap means benefits must be cut. Workers who contributed for 30 years expecting a certain retirement income will receive less. The promises made to them cannot be kept. Maria Santos dedicated 32 years to the Los Angeles public school system. She was a counselor helping teenagers navigate their futures while carefully building toward her own. She retired in January 2027, 6 months after the bottom, expecting a monthly pension of $4,200 based on the fund's published calculations. The letter she received in March 2027 showed $3,360, a 20% cut. "I did everything right," she told me. "I showed up every day. I contributed every paycheck. I trusted the system. And now, I'm 70 years old, and I have to figure out how to live on 20% less than I was promised." The system didn't fail Maria through malice. It failed her through mechanism, the same mechanism that concentrated 32% of her pension in 7 overvalued stocks without anyone asking whether that was wise. But here's the twist that makes this truly painful. While Maria's pension was being cut, the executives at the Magnificent Seven, who sold their shares throughout late 2025, faced no consequences. They timed their exits perfectly. They collected hundreds of millions in personal wealth. And when the crash came, they watched from the sidelines as the index investors absorbed the losses. This pattern isn't new. Japan offers a haunting preview. In 1989, the Japanese stock market peaked at 38,916. Japanese corporations dominated global rankings. The future seemed to belong to Japan. Then the bubble burst. By 2003, the Nikkei had fallen to 7,607, down 80% from peak. But here's the part that matters. Japan didn't recover its 1989 peak until 2024. 35 years. An entire generation of Japanese investors experienced zero returns. They didn't go bankrupt all at once. They just waited. Year after year. Decade after decade. Slowly realizing that the future they'd been promised wasn't coming. Could America experience a similar lost decade? The concentration is more extreme than Japan's was. The valuations are more stretched. The mechanism of passive investing creates downward pressure that Japan never faced. No one can say for certain, but the possibility should concern anyone with money in the market. Derek Washington worked as an analyst at a large asset management firm in Chicago. At 42, he spent his days studying these exact patterns. He still remembers the exact moment he made his decision. "I was building a presentation for clients about long-term returns," he said. "I pulled up the Japan data, 35 years to break even. Then I looked at our own concentration metrics worse than Japan's. I went home that night and restructured my entire portfolio, reduced U.S. large-cap exposure to 30%, added international diversification, added alternatives, added real assets." By 2034, while accounts concentrated in the S&P 500 are still recovering from the 2026 crash, Derek's diversified portfolio has generated positive returns in every single year except one. Different structure, different outcome. Here's a question. If the math is this clear, why do people keep their money concentrated in the same place? The answer is narrative. The story of American exceptionalism. The story of the Magnificent Seven as permanent winners. The story of passive investing as foolproof. Stories are powerful. They feel true, even when the math says otherwise. And by the time the math wins, as it always does, it's too late to change positions. Q4 2026. October through December. The bottom finally forms. Volatility remains elevated, but the forced selling exhausts itself. Everyone who was going to panic has already panicked. Warren Buffett, sitting on $325 billion in cash, begins deploying capital. Value investors emerge from hiding. The recovery begins. But for those who lost everything, recovery is just another word for watching others regain what you'll never have. The question now becomes, what do you do with this information while there's still time to act? We ended part 4 with the recovery beginning and a question. What do you do with this information while there's still time to act? The bottom formed in late 2026. Value investors began buying. Warren Buffett deployed his cash. But for those who lost everything, recovery was just another word for watching others regain what they'll never have. Now let's bring this back to where it matters most, to right now, to December 2025, to you. Everything we've discussed, the concentration mechanism, the passive investing feedback loop, the timeline of collapse, the decade-long consequences, isn't ancient history. It isn't some theoretical exercise. It's happening in real time in this moment while you watch this video. The S&P 500 sits near all-time highs. 7 companies represent 32% of everything. Those 7 stocks trade at an average P/E ratio of 42, requiring 25% annual earnings growth to justify their valuations while actually growing at 12% and decelerating. The math hasn't changed since we started this video. The mechanism hasn't paused. The concentration keeps building one fund flow at a time. Let me be clear about what this video is and what it isn't. This is not financial advice. This is not a prediction that the crash will happen on a specific date. Markets are complex systems. Precise timing is impossible. What this is simply is pattern recognition. The same concentration pattern that preceded the Nifty 50 collapse of 1973. The same valuation pattern that preceded the dot-com crash of 2000. The same mechanism that will operate again because it's built into the structure of how modern markets work. Remember David Brennan from part 1. The accountant who moved 70% of his portfolio to bonds in January 2000 because his barber was giving stock tips. I want to tell you where David is today. He's 70 years old now, retired for 13 years, lives in a quiet neighborhood outside Chicago with a paid-off house and more than enough savings to last the rest of his life. When I asked him about 2000, he laughed softly. "Everyone thought I was crazy," he said. "My brother didn't speak to me for 6 months because I told him to reduce his tech exposure. He lost 60%. I lost almost nothing." I asked David what he's doing with his money now in December 2025. He paused for a long moment. Same thing I did in 2000. Looking at concentration, looking at valuations, looking at who's giving stock tips. I asked what he sees. I see my neighbor's 23-year-old son explaining NVIDIA to me at a barbecue. I see people who've never experienced a real crash telling me this time is different. He paused again. It's never different. The names change. The mechanism doesn't. Here's the twist that makes this moment different from 2000 and potentially more dangerous. In 2000, you had to actively choose to be concentrated in technology stocks. You had to pick Cisco, Intel, Sun Microsystems. The dot-com crash hurt those who made active bets on specific companies. But today, concentration is the default. If you have a 401k, odds are you're automatically invested in an S&P 500 fund. If you have a target date retirement fund, you're automatically allocated to market cap-weighted indexes. You didn't choose to put 32% of your savings in 7 stocks. The system did it for you. And that's what makes this concentration so much more dangerous. Millions of people are exposed without ever making a conscious decision to be exposed. If you could see a map of America right now, with each household colored by their exposure to Magnificent 7 concentration, you'd see red everywhere. Retirement accounts, pension funds, college savings plans, insurance company portfolios. The concentration has seeped into every corner of the financial system silently, automatically, without anyone asking whether it was wise. Let me offer a framework. Not advice, just questions worth asking yourself. First, what percentage of my financial future depends on 7 companies maintaining valuations that have never been sustained in market history. Calculate it. The number might surprise you. Second, if those 7 stocks fell 50% and took years to recover, how would my life change? Would I postpone retirement? Would I lose my home? Would my pension be cut? Third, do I understand the mechanism that put my money into these positions, or did it happen automatically while I wasn't paying attention? These questions don't have right answers. They have your answers. And your answers determine which trajectory you'll be on when the mechanism finally reverses. Remember Jennifer Okafor from Part 1, the software engineer who held $340,000 in tech stocks in March 2000, watched it fall to $94,000 and is still working at 59 because she has to be. She's real. Her story is real. And somewhere in America right now, there's another Jennifer, a different name, a different city, a different portfolio who believes her diversified index fund will protect her. Who believes the Magnificent Seven will keep growing forever? Who believes this time is different? Sandra Mitchell is sitting in Phoenix right now, in December 2025, checking her 401k app while grading papers. $847,000. She feels good. She feels safe. She doesn't know that 32% of her savings, $271,000, sits in 7 stocks that require impossible growth rates to justify their prices. She doesn't know because no one told her. And by the time she learns, it will be too late to change her trajectory. That's not a prediction. It's a pattern. The same pattern that is repeated for a century. The same pattern that will repeat again because human nature doesn't change and market mechanisms don't pause. Here's the signature line of this entire video. The truth that underlies everything we've discussed. Concentration creates fragility. Fragility creates collapse. Collapse creates transfer. And transfer always moves wealth from those who didn't understand the mechanism to those who did. This isn't about being bearish or bullish. It isn't about timing the market or predicting the future. It's about understanding a system that operates whether you pay attention or not. The passive flows keep flowing. The concentration keeps building. The valuations keep stretching. And somewhere ahead, maybe months, maybe quarters, the mechanism reverses. The question isn't whether you believe it will happen. The question is whether you've looked at your own portfolio and understood what you actually own. Because the market doesn't care what you believe. It only cares what you hold.